So today we are reviewing my portfolio. There are so many trades happening. I'm getting ready for 2026. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk. Dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend growth investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Véronique, and no, we are not recording on Christmas Eve, but yet Merry Christmas to you, Vero.
Well, Merry Christmas to you as well, Mike, and to our dear listeners. Thank you for listening to us even on Christmas Eve. And if you never done it before, please share what we do with others so we can grow this podcast and make it even better. And listeners, please make sure to enjoy the holidays with your loved ones because what really matters, right, Mike?
Yes, not necessarily listening
Actually,
to us on Christmas Eve, right? Wait a couple of days, like do that on Boxing Day or something.
well, there could be a way to listen to a podcast on Christmas Eve and like during Christmas during the morning and then, putting that aside and coming back to it 2, 3 days later. That would make sense.
I'm pretty sure I'm going to listen to a few of my podcasts in the morning though when
Exactly.
I'm walking my
Exactly.
dog. So that's a fair point.
All right. So, and by the way, you might hear that my voice is not as beautiful as usual because my son won a hockey tournament last weekend and I was so excited and it was so tight that I yelled too much. So, this is why I have this weird voice today, but we should be good. So, today we put Mike's portfolio to the test. He's been advocating for clear rules for years. Now is the time to see, does he take his own medicine, right? So let's see how Mike's portfolio is doing and what trades and plans on making before 2026 starts.
Yeah, so I actually took a little bit more advanced than usual. Most of the time, I wait until the holidays to do my trades around like the 27th or the 28th, but I was able to do them at the beginning of December this time. I was taking a lot of notes, and yes, well, actually, I'm not super happy about my performance this year, but I did follow my investment rules. So we're gonna take a look at those and maybe some surprises. I don't know. Let's take a look at what's under the hood.
So before we start, remember that the stocks and trades we will share today should not be considered as buy or sell recommendations. You must always do your due diligence to see if these ideas align with your investment goals. So, Mike, let's do an overview first. How does your portfolio perform this year compared to your benchmark?
So it was pretty bad. I'm going to end the year around 8-9% up. That alone is not that bad. But when you look at my benchmark, which is 50% US market, 50% Canadian, the benchmark will probably show like up 20%. So I'm not just behind, I'm like on another track right now. So that even brought my average return, my analyzed growth rate return, since 2017, pretty much face to face with the benchmark. So it's been 8 years and counting that I'm comparing my portfolio versus the benchmark. Most of the time I'm ahead. Sometimes I'm way ahead. And right now I'm pretty much the equivalent. So at this stage, I cannot say that my portfolio is beating the market, but those type of things can change rapidly.
Right. So, which stocks or sectors are the winners in your portfolio, Mike?
So that was quite easy to take a look at by just running my DSR Pro portfolio report. I got that answer right away. So not very different than what's happening on the stock market, but a few exceptions. So of course, on the Canadian market, we have like a huge run on anything that is related to gold. So gold miners and such. I don't have any in my portfolio, so that's not helping. The financial industry did well. So my National Bank and Royal Bank are up 34%. Brookfield is up 22%. So that was a pretty good portion of my portfolio that went up. I also had a few good picks in utilities and industrial. So I have Toromont Industry up 45, Brookfield Renewable making a huge comeback up 45
Mm,
as well, including the dividend, of course. So this one was dead money for a while, but always reporting strong metrics. So just to show that sometimes it pays to be patient. And I started the year with a small position in Dollarama. So the small investment I did is up about 40%. Unfortunately, I just completed my full position just now. So I did not enjoy the full power of this increase. And then overall, if you look at the US market, the market was driven mostly by utilities and then the technology sector and communication as well. So Alphabet, Meta, that did great. So I don't have those in my portfolio, but Apple, Microsoft were not too bad, but they were not like outperforming the market per se.
right. So, Mike, now you've said that you're lagging your benchmark. So, which stocks are struggling?
So I do have a few losers in my portfolio, and it's ironic because some of them are showing very strong numbers. So automatic data processing, it has like a perfect dividend triangle. It grows like high single digit to double digit quarter after quarter after quarter, and yet this year it's down 9%. So it kind of sucks. But again, instead of looking at a very short number of months, which is only 12, I rather to see the big picture. So I'm super confident
Mm,
about this one. There's absolutely nothing wrong about it, besides the fact that the market is expecting a slowdown in jobs, and it's also a bit concerned about the advancements of AI that could probably hurt payroll service such as automatic data processing. I don't
mm,
necessarily agree with that thesis, obviously. And so far, the numbers are on my side. So again, pays to be a patient investor for the long run. So I'm not going to make any change on like on the stock that is down 9% while the market is up 20. Similar story with Lemite Vascular. We discussed that one not too long ago. This one
mhm.
again, it's a small cap, so maybe that's the reason, but they're growing fast. The dividend triangle is very strong as well. So I don't see why the stock is down 7%, but that's what it is. Kushtar, I mean, we have been talking about this one a lot. The last two quarters were better. We see some light in terms of comparable sales growing. Not super fast though, but still it's one foot towards the right direction. This one also is down 6%. I got Home Depot, a very, very robust company, but from time to time it's cyclical. And the other reason right now is, and we see it, consumers are tight with their budget. That affects Alimentation Gauchard, that also affects Home Depot. So the tickets per transaction is lower, meaning that
Mhm.
people, yes, they're still renovating, but I mean, if you just add a new coat of paint, it's not like if you do your bathroom. So I tried to help
Right.
as much as possible with my own home renovation, but obviously it did not move the needle enough. So I will have to shop more at Home Depot in 2026. I don't know what else I can renovate in my house, but anyways, that's one thing. And finally, I made a defensive play at the beginning of the year with Waste Connection, and this one is pretty much flat. So not a bad performance, but when the market is up 20, then you can say it's a bad performance. So
Mhm.
because of those companies that are lagging and negative are in negative territories, that explains why my portfolio is not doing that well in 2025.
And by the way, I just want to add a note here because my question was which stocks are struggling? And then you answered using the word lagging, which is way more well chosen for what it is. Because I mean, it doesn't mean that when a stock is down, the company is struggling. It just means performance is not there this year. It's just 1 year.
Definitely. And I see a lot of investors giving value for short term returns. Like, in other words, if stock ABC is up 25%, it's a great investment. If it's down 25%, it sucks. It's not exactly how it works. And especially if you're just basing your decision on short term returns, you're going to keep buying and selling all the time without even knowing what's moving the needle. And I prefer to look at the metrics as we discussed. And exactly, like the returns are struggling, but the companies are not doing that bad. I mean, like none of those companies are going to cut their dividend in 26, and they will all actually increase their dividend. Some of them will probably go double digit on top of that.
Hmm. All right, so Mike, you review your portfolio quarterly, but you act on a yearly basis. Which notes did you have before this year-end review?
Yeah, I always try to be super patient with my portfolio. So instead of trading based on a bad quarter, what I do is I took a few notes every times I review my portfolio. So that's like 4 times a year. And then when it comes the end of the year, now I take decisions. So the notes were taken for Alimentation Couche-Tard and Starbucks, kind of like not exactly the same time of business, but in the same type of situation where they used to grow fast and now they are struggling for with their growth, and it has been a few years. So I was looking at both of them, making sure that metrics are coming back or not, and then looking if management had a plan or not, and also having an eye on the dividend increases. So those are the notes that I usually take to help me take a decision at the end of each year.
So which holdings turned into sell trade?
Well, Starbucks, and I could have added this one into. Actually, this one is struggling and as is lagging the market, so it does both.
Right.
So for Starbucks, what happened there is I have been waiting for 3 years, where the dividend triangle is getting weaker and weaker. So we have like a little bit more of revenue growth, but the earnings were down during that period. Management came up with a plan, wanted to simplify their menu. They changed the CEO. They actually had a pretty good run at one point, saying, hey, things are probably going to move towards the right direction. And eventually the numbers came back not that great. So 3 years down the road is enough, in my opinion, for the company to turn things around and not necessarily going back on a super fast track for growth, but at least
Mm.
to show that there's some improvement. And one of my investment thesis here is I believe that Starbucks is going to grow in China. And now they actually struggled over the past few years and they sold a good part of their business in China as well. So that
Mm.
coupled with the latest dividend increase that was less than 2%. So pretty much hitting all the boxes for me to sell. So the investment thesis is not there anymore. The dividend triangle is getting weaker. The latest dividend increase shows that management has other priority. And I mean, it's a good move, but it just reinforced my decisions of selling it and moving away. The good thing is I used to make a lot more profit on Starbucks, but I sold at a pretty nice profit. I was up about like 80% with the dividend since I bought it.
Mm.
So I cannot really complain. If I would have sold it 2 years ago, I would have made more money, but that's part of life, right? Sometimes you wait, you're patient, and the stock recovers. Some other times, I mean, you play Monday morning quarterback and say, oh, I should have sold 2 years ago.
And now, what was the verdict for Alimentation Couche-Tard? Are you still waiting a few quarters to see how it's going?
Yeah, so for Kushtar, I'm not that worried. I'm actually in like we just completed year 2 of my wait period. The last 2 quarters were better, so I'm expecting this recovery to continue in 26. The 7-Eleven saga is probably over finally. So now we can hope for better deals to come and a new narrative to come out of 2026. So I'm still going to take notes on this one, though. I believe it has everything in its power to make the shift. They have a strong management team, they have their plan, and they have this habit of having a plan, following it, and actually getting those results. So I'm a big believer of the process in everything that I do. So when I see a company that is actually following a clear process, well, then I think that the likelihood of seeing them being successful is higher. So I'm not really worried at this point. Definitely not happy, but I mean, again, it's part of the game, and I'm willing to wait a little bit more. I don't want to do another McDonald's. A few months ago, we discussed that one where I waited maybe like a year and a half, and nothing was going right with McDonald's back then. They had trouble with their menus. They changed like a bunch of stuff, but they were not able to grow their sales. I eventually sold it, and this one started to go higher up like very fast, maybe like 2 years after or something like that. So that's why I'm more patient now, and I can very sleep well with Kushtar in my portfolio.
All right, so now we record this like just a few days after TELUS paused its dividend growth policy. That day, I remember I wrote to you about it. No, you wrote to me about it because it was part of a deep dive for DSR members and we had to update it. And I remember asking you if you would sell TELUS soon, and you replied like almost instantly, already done. So, how quickly was your decision made, and how hard is it to follow your rules?
So Very quick, mostly because it was part of my investment process. So, to be clear, for some people that may feel lost because we haven't talked about TELUS today, TELUS is not in my pension plan portfolio. It was in my RSP. So, that's why we don't initially talk about it when we do the quarterly earning. But it was such a big news that we had to talk about it. And actually, DSR members received a 4,000 words deep dive on it. I went into the debt, the cash flow, the prospect, the growth vectors, the payout ratios, the fact that they're issuing shares right now through a drip, everything that has been covered. So at the beginning of 2025, I told my members, and mind you, Telus was like 2.5% of my portfolio. So like nothing, I didn't cry about it or anything else. I was just like, okay, that's you're gone. You act as a deluxe bond with a generous dividend for a lot of years, definitely not performing as well as the market. But I mean, I did not lose money, but it was time to go because at the beginning of 2025, I told my members, I'm watching Dallas every quarter. I'm taking notes the same way I did with Starbucks and Kushtar. And one thing that was really crucial for me at the beginning of the year was the potential announcement of the new dividend growth policy. So for
Mhm.
several years, the dividend growth policy was to hike the dividend by between 7 to 10% per year. They did that for several years. And then, of course, problems started to rise. The growth was not there anymore. CapEx was really intensive. The debt and the interest charges started to ramp up. And I was ready to sell at the beginning of the year. But they came and the cash flow metrics have been better in 25 throughout the year. And at the beginning of the year, they said, oh, we are going to issue a new dividend growth policy that will be growing by 3 to 8% per year. And they announced a 3% ish dividend increase back then. Fast forward to last quarter in late November, beginning of December. And then they announced another 0.5% increase, not that much, but the total for the year was about 4, which was more than I expected. So I was like, okay,
Mm.
so they are still growing their dividend. They do have a plan. It's kind of like well laid out in terms of plan. They're actually doing what they say they would be doing as opposed to Bell. Because I mean, back then, Bell, a few years ago, they sold their stake in MLSC saying, oh, we're going to pay off debt. And then 7 weeks later, they said, oh, no, we're going to use the proceeds to buy Ziply Fiber. So it's literally saying, okay, so I'm going to sell one of my 2 cars to pay off my loans because I have too much debt. And then I'm going to tell you, oh, well, I bought a boat instead. So not making much sense. TELUS actually spun off their tower business into Terion, sold 49% to La Caisse de Dépôt, used 1.2 billion of that proceeds to pay down their debt. So they're actually doing the right things. But then we had some pressure from analysts. We had the bad articles in the Globe and Mail. And I kind of feel that management was influenced by all of this. So about a week after they reported their earnings, they issued a new statement saying, yeah, we still have the same cash flow improvement plan. Nothing has changed, but we're going to put a hold on the dividend growth policy. So they went from 7 to 10 last year to 3 to 8 like 6 months ago to nothing in like a span of a few months. So, of course, I focus on dividend growers. TELUS is not a dividend grower anymore. So here you go. It was not fun, but it was really easy to follow those investment rules. And they have protected me several times in the past. So I'm going to keep on doing it. So there you go. I got rid of TELUS. And pretty much as soon as I finished reading the press release,
Okay, so now, Mike, what did you do with the proceeds of your trade?
so when I sold Starbucks, I added more to 2 of my positions. It's kind of funny because we just discussed those. So automatic data processing and Lemite Vascular. So they're both down, but they're both showing strong metrics. And I kind of like when I see a company with a strong dividend triangle and I have more capital and the stock price does not follow. So I believe it makes more sense to make those kind of trades. So I just rebalanced my portfolio by increasing those positions. And for the story about TELUS, I wanted to have a full position in Dolorama at the beginning of the year. I was clear about that. So, of course, I used the proceed to actually complete my position in Dolorama, which is now about 3%. I cannot remember. It's like 3% ish of my all my investments across different type of accounts.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you.
Okay, so another thing that usually leads to selling shares during your process is when a stock exceeds 10% of your portfolio. Which ones did you have trimmed this time?
Apple for the fourth time now. It's kind of crazy. And again, a lot of people will tell me about Mike, if you have kept all your shares of Apple, you would have been better. But right now, my portfolio would be like 30% Apple or maybe 35. Because at one point, it went up to
Okay.
like 18% the first time I trim. And then I realized, what if Apple goes down and I'm like, and it's over? So I want to protect my portfolio against myself. So even though I love the stock, I always trim a little bit more. But still, to this day, Apple is almost 8% of my portfolio. It's still my largest position. So I'm still running on it greatly. But I also wanted to jump into Broadcom for so many years. So I was really excited to sell a few shares of Apple to buy Broadcom. I don't think I'm
Right.
going to end up as a big losers on this one. It's probably going to be either like an even trade or it's going to be in favor of Broadcom. So I didn't mind when I saw Apple going up at their all-time high. I just trimmed a little bit as soon as it's like a little bit more than 10% of my portfolio. So as of today, my top five now is Apple at 7.78% of all my investments. National Bank, big surprise, second largest holding at 7.15. I got Kushtar at 6.18. Then we have Brookfield Corporation at 5.59. And the last one on my top five is Microsoft at 5.4. So feeling pretty strong about my top five, actually.
Right, right. So, Mike, to help listeners do their own year-end review, please remind us of your step-by-step process.
Yeah, I follow always the same one, so it makes it easier. So the
Mhm.
number one, I mean, this one I don't even do it anymore because it's already incremented in all my portfolio, but is to set your strategy, set your mandate, act like a portfolio manager in a sense where you should know what is your strategy about, what you focus on. So I'm very clear about that. I focus on dividend growers, so companies that have this ability to increase their payout every single year. I make very rare exception. I want to be invested at all time. I want to be 50% US, 50% Canadian. And I'm thinking about long term. So my portfolio today is for the next 50 years and moving forward. Thinking even if I would be 75 today, I would be just thinking about the next generation. I would not think about the fact that I could die in the next 10 years, but rather say, well, one day I'm going to die, but my portfolio will remain. So I want to think the same way as I am right now. So that is like basically just setting the ground rules of like what you want in your portfolio. The second step is to review your asset allocation, sector allocation, and stock allocation. So the asset is, of course, in my case, it takes about a second because I'm always 100% invested. So I don't have to worry about too much. But the only thing that I look at is the difference between US and Canadian. So from time to time, I have to sell one or the other just to trim a little bit. Usually I will wait until I'm 60/40, not necessarily trade if I'm 54 and 46, not to
Hmm.
just like trade for trading. I mean, that's not the point. The point is more just to respect that balance between both. But at the same time, it's not an ultimate rule where something terrible is going to happen with my portfolio if I'm 60/40. It's just that I don't want to wake up one day and eventually being 75/25, right? So
Right, right.
once I'm done with that, I will look at my sector allocation. I don't want to be over 20%, but I can tolerate being between 20 to 30% in a specific sector if I'm invested in different industries. So, for
Mhm.
example, if I have, like right now, I'm slightly overweight into technology, but Constellation Software is not exactly the same business model than Microsoft, than Broadcom, than Apple. I also have like a small position in CGI, but the point is, if I add like 4 or 5 semiconductors like Intel, AMD, Nvidia, and Broadcom, then if anything happens around AI, that's going to make a big blow. Right now, I mean, Broadcom and Microsoft were doing well before AI. Now they're using this one as an additional growth vector, but it's not the only thing. Constellation Software is not using AI as a positive tailwind right now. It's actually, there are some people that have concern around it. So while they report great numbers, the stock is down big time this year. That is part of my another portfolio. But just to show how one could be more diversified if they invest in different industries in the same sector. So I could tolerate
Mm,
that. But above 30%, I mean, I'm going to create overlaps. So similar companies with similar business models. So I'm just increasing the risk. Might as well just pick the winner or pick the one that has like the stronger metrics instead. And once I'm done with the sector allocation, I look at the stock allocation. So good example was Lemaitre Vascular and ADP were relatively smaller position, not that much, but I mean, they were like slightly under 3%, mostly because some other companies like grew faster. So it was a good timing for me to just reinvest in those and bring them back in the 3% ish, which is my ideal position. So when I have a stock that goes up, I will let it go up until it's 10%. So
mm,
no intention right now of selling National Bank at 7% or Microsoft at 5.4. I'm going to let them continue to go up as long as they are not more than 10. But ideally, I would like to have like fully weighted portfolio around 10%. So that helps me to have to determine if I should invest in a stock or not. So that's the
mm.
second part, is really just global view, sector asset allocation, sector, and then stock allocation. And then finally, I look at my weaker positions. So weaker in terms of like the smaller ones or the ones that have like weaker metrics. So Starbucks was a good example where the dividend triangle stagnated and started to go down for the past 3 years. Smaller dividend increase, and at this point I'm like, you know what, now it's time to take a deeper dive on this one to see what's happening. And that leads to step number 4, is to pull out trades. So instead of saying, oh, I'm going to eventually sell Starbucks until when it's like $88 or $90, or like a lot of people like to have like those numbers they made up. But I mean, they made up to make you feel good, but there's no rationality to say it's going to hit 88 or 88.50
Mm.
or 100 or whatever numbers, right? So I might as well just say, you know what? I'd have determined that I've lost confidence into this holding. It's gone. Let's move on. Let's move it quickly, and having your buy list on the side ready to go, having that plan, knowing where to go, makes it a lot easier as well.
Okay, so looking in 2026, what will you keep an eye on for your portfolio?
So Kushtar, as I mentioned earlier, but besides that, everything is pretty solid now. I'm pretty happy with what I have in my portfolio. So I don't necessarily intend to make a lot of trades. I'm confident again for Kushtar because the last 2 quarters were better, but we need a little bit more than that. So it's not out of the wood yet. The other thing that I will do though is I will increase my Smith Manager portfolio contribution. So last year I was at $750 per month. I'm increasing it to $1,000. And I do have another portfolio that I started at the beginning of 2025. I have like a series, like every month I discuss which stock I buy on my YouTube channel, the
Mhm.
Dividend Guy channel. And this one is also another $1,000 per month. So I'm contributing now $2,000 per month into 2 different portfolios moving into 2026. Part of a plan, like a larger plan to build a stronger financial future for myself and my family.
All right, so despite the fact that your portfolio was lagging a bit, I didn't feel any panic coming from you, Mike. So my question will be on the opposite. What are you most proud of about your investment?
You know, it's always fun to brag that you beat the market. And on average, I do it. So I don't really mind, but I'm not here to chase return. I'm here to
Mm,
achieve my financial goals. And I don't need to beat the market to do that. So when I look at where I started in my 20s versus where I'm at right now at the age of 44, I'm really proud to see the power of compounding interest. I mean, that is just crazy to see like how fast that one. At first, it starts very slow, and then eventually it goes up super quickly. And
mm,
the other thing is, I didn't add much capital for 7 years between 35 and 42. I did not add a penny because I invested most of my money, actually all of my money, into the business, which has been my greatest investment of all time. Of course, the returns on DSR is way above what the market can provide, but that's usually what happens when you run a business. You either die with it or you're making more money. So I'm super happy to see that the strategy works because I could not hide behind the fact that, oh, the portfolio is not up that much, but I added like $20,000 or $30,000 this year. Well, I didn't add any capital and it's still
Mm.
up. So again, very happy about that. Staying invested throughout everything that is happening and that happened, and being committed to the same strategy. It's been since 2010 that I focus on companies that has the ability to grow their dividend, and never changed my mind in the past 15 years. So I don't see why it's going to change next year, but this is something that I'm super proud of because it makes my life a lot easier. I'm not stressed. I know I have full control. I mean, when you have a bad year and your year is like high single digit, it's a good thing to have. And
Right.
I always remind myself that whenever the market is down, such as in 22 or 2018 or even 2020 at the worst part of the year, my portfolio was way better than the market. So I remember that when I select thriving companies with robust balance sheet and solid metrics, they will go through any kind of crisis, and that is the most important part for
Well, I think it is fair that you use your own medicine, Mike. So thanks for being transparent about your returns and your rules and for giving us concrete example of what it means. So listeners, to access Mike's latest dividend income report with tables and charts, you may want to visit the dividendguideblog.com/259. This is our show notes and I will put the link there along with the link to Mike's YouTube channel, The Dividend Guy. Next week, we will receive a guest on the show, Ross from Dapper Dividends. We will discuss dividend traps and safety metrics. And I can tell you, because I've already recorded it, it's so much interesting. I just like that guy so much, so you don't want to miss this. Hit pause and the subscribe button underneath our logo to not miss it. Until then, Merry Christmas! And don't forget to stay invested.
Stay invested. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time.